Good evening, everyone, and a very warm welcome to this new product launch from Edelweiss Asset Management. As you are aware, we keep coming up with new and innovative products for great client experience from time to time. And following up on our multiple launches over the course of the last 5 years that have added a lot of value to clients, we are coming up with a new product, the Nifty Alpha Low Volatility 30 Index Funds. Now, you will also recall that over the last 1.5 years, we've launched some of these very compelling solutions in the mid-cap and the small cap space. And we thought it was time to, launch a smart beta factor-based fund in the large cap space as well. And with me, we have our product head, Niranjan Avasthi, to take us through some of these, the presentation and some of the solutions that we have. And, these ideas have been scaling up very nicely. And we think this is a time where investors are also looking to diversify into large cap, given the fact that mid and small caps have had a big rally. And there might be that large caps play catch up in 2024. So with that, let's dive straight into the Edelweiss Nifty Alpha Low Volatility 30 Index Fund. Niranjan, welcome to the call.
Thanks. Hi, Varun, and hi, everyone.
Niranjan, let's first understand what is a smart beta product and how is it different from some of the other indices?
Right. We all would be familiar with, a basic market cap based index like Nifty 50, Nifty 500, Midcap 150 for that matter. Now, these indices are based on very simple market cap based weighing, which means the highest stock in the universe gets the highest weight based on its free float and so on and so forth. Moving beyond that are single factor indices, wherein one factor, whether it is volatility, whether it is quality, momentum, alpha, or value, and each of these factors defined by certain metrics are applied over these normal market cap based universe, and a single factor indices is created. A case in point would be Nifty 100 Quality 30, on which we already have a fund. It is basically a Nifty 100 universe based on which the top 30 quality stocks are defined basis EPS growth, low debt to equity, and ROE, and so forth. And the third category is a multi-factor index where multiple factors, whether it is two or more factors, are combined together, and then an index is created. Let's talk about the current example, which is Alpha Low Vol. It's basically a universe where we take top 150 stocks which are listed in NSE, and these top 150 stocks are then aligned as per their alpha scores and low vol scores. And from this universe, combining these two factors, the top 30 stocks are selected, which has a combined score which is highest, and the top 30 which has the highest top 30 scores are selected, and the weights are assigned basis their score, and that's how the universe of 30 stocks are selected. Now, basically, it's quite simple. If you look at Jensen Alpha is basically a factor which defines stocks that are doing well based on their price return over the last 1 year. And low vol is simply stated stocks which have lower standard deviation. Now you can combine these two, which is stocks having highest alpha, or probably appropriate to also say that highest excess return over benchmark, or are outperforming in the market. You assign scores, and on the other hand, you take the same universe and also assign score based on their standard deviation. The lowest standard deviation stock will be at the top, and so on. And when you combine these two, you get a 30 stock portfolio which has both these characteristics that are outperforming well or outperforming the market, at the same time are low volatile. So this is broadly a multi-factor indexes, and this is one of the multi-factor indices that we have seen. And we have chosen this index in the large cap universe because today, Varun, we all know that in large cap, uh, alpha is something people keep hunting for, right? And
Yeah,
it's a heated debate. And actually, even when you look at the normal market cap based index, which is Nifty 50 or Nifty 100, 40-50% of the time they do underperform the active funds as well, which means even they are struggling to generate alpha against the active funds. So
that's correct.
if you want to put it the other way, both active funds are underperforming during some cycles. At the same time, market cap based indices are also underperforming in some cycles to generate that alpha. And we wanted to solve this problem, and hence we selected this index, which kind of outperforms, and we'll discuss more about the
Sure.
numbers and add its outperformance later. But we thought this solves a genuine problem for investors, which is generating alpha in the large cap space, and
So
that's where
Niranjan,
this product will be. Yeah.
sorry. So from what I understand is it takes the top 150 stocks by free float market cap of NSE,
Yes.
takes out the non-FNO stocks out. So there are
Yeah.
stocks which are not part of future and options or derivatives are not included. And stocks that have been listed in the last 1 year, they are excluded. And the balanced stocks are taken. A
Yes.
50% weight is given to Jensen's alpha, which is excess return over the benchmark. And 50% weight is given to volatility, which is standard deviation. And a portfolio of 30 stocks is constructed based composite score. Now,
Yes.
Jensen's alpha and volatility are two very, very opposite things of the spectrum. Alpha
Yes.
is all about chasing returns, and volatility is all about streamlining those returns and having a very measured approach.
Yes.
Uh, what exactly is this in more simpler terms for an investor in terms of what does it do? What is alpha and what is low volatility? How does it work?
Right. When we combine these two factors, one thing that you get is, a consistent outperformance across cycles. Because like any factor, a single factor will always have its own cycles of outperformance and underperformance. And that's where we combine these two. Now, what each of these factors means. Alpha. So alpha basically, as you rightly mentioned, Varun, it is basically a factor which does well uh, during upcycle in the market. It captures the excess returns that the stock is generating, and it's broadly a pro-cyclical factor, which means it usually does well or outperforms well when markets is trending upwards. On the other hand, volatility is a factor which is known for its defensive stance. So it is a defensive factor. It outperforms in a falling market or a volatile market. And the main aim, the main motto of this factor is to generate better risk-adjusted return. Now, when you combine these two, what happens is if we are in a big bull market like we are in today, the alpha factor overpowers low vol and it tries to pick up stocks that are generating excess return. At the same time, you also need to be sane, when markets are running up, because that's where most mistakes happen. Low vol is a factor which controls this alpha factor and says, okay, also select stocks which are low on volatility, so that if the tide turns, you are saving some of the drawdowns whenever it comes. So these two complements each other very well. One is running fast, the other is stabilizing the run, or balancing the run, which
So,
means,
so
yeah.
as I look at, just to put it in very simple parlance, if you're driving a car
Yeah.
and you have an empty road, the alpha factor will kick in where you try and speed up and make up for time. But as you hit more traffic, that is where volatility will come up and it will basically make the ride smoother. And over a period of, say, the entire journey of the drive, make the drive more accident free.
Absolutely. Absolutely.
Perfect. So, this itself looks on the face of it, something that should give out great returns. So I think evidence of anything is in data. And let's jump to the data and look at it. Now, when we take a look at data over last 10, 5, 3, 2, 1, 6 months, and 3 months, the first column on your left is the returns that the Nifty Alpha Low Vol has generated minus 1% expense that the fund will run. The second column is the benchmark itself, which is Nifty 100 TRI. And the third column, which is on the extreme right, is the column of the top 5 large cap funds, which it's competing against their returns. And mind you, these top 5 large cap funds have changed over all of these time periods. And what you have is over a 10-year period, it has outperformed the top 5 large cap fund average by about 300 basis points. Over a 5-year period, again, there is outperformance. Over a 3-year period, again, there is decent outperformance. And over the short term, which is 1 year, the outperformance is significant. So like what Niranjan mentioned, that during the up cycle of the market is where alpha gear kicks in, and during the down cycle of the market is where the gear shifts down into protecting returns through investing in companies that are low on volatility, which essentially complement each other to give out great returns for investors. Now, Niranjan, you mentioned that both these factors combine and construct a portfolio. How is this portfolio really, really different from the benchmark itself? Let's cover that at length to just allude to the point that is the portfolio similar? Is the portfolio very, very different?
Right. When we look at any backtesting, one thing which we look for is where are the returns coming from? And that is very important because, backtesting, a lot of people say it doesn't happen in real. It is only backtested or maybe force fitted based on the data. But, this data, maybe if you go back, Varun, on the sectoral, charts for last couple of quarters. Yes, yeah. So, when we look at the data, it showed that this strategy is able to change the stance very quickly. One drawback in a market cap based strategy is the allocation to sectors moves very slowly. Now, today, if you look at a Nifty 100, allocation to banks or finance is roughly around 30-35%, more than that. Now, if banks and finance underperforms, the overall Nifty 100 performance goes for a toss. At the same time, a sector that is doing well, let's take example of, say, pharma at the moment. In last 3 and 6 months, pharma has done very well. The representation of pharma as a sector in Nifty 100 is just about 7-8% or less than that. Now come to this index, which is Alpha Low Vol. You will see banks today has a very small exposure versus Nifty 100. And banks have underperformed. At the same time, exposure to pharma is amongst one of the largest, roughly about 20% odd. Now this is driving the outperformance. If you see last 1 year, you mentioned, Varun, the outperformance is significant. The outperformance coming from here. If you go back maybe in 2021, IT as a sector was doing very well. And here, the exposure to IT was roughly around same 20-22%. From there, after 2022, IT didn't perform. 2022 was actually a bad year for IT, where it held a lower exposure in IT versus a Nifty 100. Now, this dynamic allocation or dynamic sectoral rotation is what drives excess return. And this is the reality test of any strategy. Because today in India or any markets, in no time, one sector becomes an underperformer. And how swiftly you change stance is what drives alpha. And this index, because it's a multi-factor index, it does it very, very well. And it has shown this, at least when we looked at the data for for past, multiple years. And as we come to that same exposure today, the next chart which you were showing, Varun, uh, here is the key differentiator. Financial services holding 32% exposure in Nifty 100. In this, it is just 6%. What is driving the outperformance, and we believe that it may drive further, is healthcare, that is 18%. Auto is around 19%, which is just 7% in Nifty 100, and so on and so forth. Now, this is where the difference is, and this also complements any of your existing index funds or your active funds, because most active funds in the large cap space specifically follow a benchmark hugging strategy, and their overweight underweight stance in any sector is usually not more than plus minus 5%. Here you can see it is right from 0% to 25%. And it does it very swiftly and beautifully. Hence, this strategy, even if you are invested in a large cap strategy today, which could be a core exposure through Nifty 100 or maybe an active large cap, this complements very well, because when that strategy underperforms for maybe a couple of quarters or years, this strategy complements and outperform.
Yeah, it makes absolute sense, and data is evidence, and data clearly suggests that. In fact, what we also get a lot of questions, Niranjan, is on how the returns have been over different market cycles, how the returns have been during different financial years periods. Now, when I look at this data, what again I come to see is, especially during those periods where markets are falling, this fund does really, really well. So if you take a look at financial year 20, where the benchmark, which is NSE 100, corrected by almost about 25%, this fund actually saved downside by 900 basis points at about 16%. In that period of FY23, which was really, really volatile with inflation and interest rate movements, etc., NSE 100 corrected by about 1.6%. This was flattish, didn't give you negative returns. Also, that period of FY16, if you will remember, NSE 100 corrected by about 7%, and this was flat. So in all those three periods, this actually protected downside. And in periods where markets went into an upcycle, which is FY24, this period of FY20, the period around FY17 and FY15, this gave you a much superior outcome compared to the benchmark itself. So Niranjan, two questions here. The first one is, why is it that during these three periods of market fall, this did so much better?
So as we were discussing, Varun, low vol is the main factor which controls this entire scenario. So like just before COVID, if you see, FY19 and FY20, the performance was very good in the market, and any strategy which is following maybe just alpha or momentum would have done very well. At the same time, when the tide turns, a single factor index may underperform, especially during drawdowns, but low vol is something which ensures that in a portfolio, there are always stocks, whether it is from a defensive sector or are scoring high on defensive factor, are significant part of the portfolio, which saves you from drawdown. When we looked at the charts, from 2021 till now, if you go back in 2020, while that data is not here, we were looking at the data. The exposure to healthcare and some of the FMCG names was quite significant in the index, which actually ensured that the drawdowns in the index are lower than the overall market cap based market or broader market fall. And time and again, this index has shown that ability. If we go back in 2008-9 as well, it did fell lesser than overall broader market. And over there also, the exposure to defensive sectors, whether it is healthcare or FMCG or maybe IT to some extent, was the savior during that period of time. So low vol is the main factor which does its magic during this period, I would say.
The second part of this is, when I look at this data, Niranjan, two observations of FY21 and FY19 come out where the Nifty 100 has outperformed. Now, I can attribute FY19 as the outperformance, because in that year, the rally was driven predominantly by a handful of 5, 6 stocks, which have
Yes.
a very big overweight position on the index. I recall some of those large private sector banks and an oil and gas company. But what happened in 2021, where this fund underperformed by about 24%? And can this keep happening over other multiple cycles where, if there is a correction and then from a correction, there is a bounce?
Right. So, when we talk about any strategy, there are certain periods where the strategy may not work. Thankfully, in this strategy, such periods are very short-lived compared to any other strategies. And what are these periods when this kind of strategy may not work or underperform is a period where there is a sharp reversal in the market trend. Specifically, when markets had fallen, when it outperform the market by saving your drawdowns. Now, when the tide turns, there could be, only one or two sectors which could do well. In 2021, FY 2021, there were sectors like IT, maybe to some extent, a few healthcare stocks, not the entire healthcare, but diagnostic companies and all did extremely well. And it was not a broad-based rally, but I would say only two, three sectors contributed a lot significantly to the overall market. Now, during this period, till the time the benchmark or till the time the index doesn't, change its, or reshuffle its stocks based on alpha and low vol, it may underperform. If you actually break down this into month-on-month period, it is only initially 3, 4 months where the
Yeah.
index underperformed, and later on it caught up to the trend. So these kind of period is where the index underperforms. But if you actually, while we are looking at FY21 separately, FY20 separately, if you combine this entire 2 to 3 year period, it actually did very well because it saved you by 900 basis point. And we all know that, if you are saving 900 basis point, the upside, even if you capture maybe 1/4 or 2/3 of the upside, in the overall market rally or overall cycle, you do extremely well. Our balanced advantage fund is the case in point here. So similarly, when you look at the entire period, this index did perform well. But yes, the point is during such periods, whether it is 2009 reversal, we have seen the strategy underperforming for a few months, and FY21, where initially 4, 5 months when the tide turned, it underperformed. What is good about this strategy, as I mentioned, unlike many other single factors, this strategy bounces back very fast. So it is only a matter of few months it underperforms. And Varun, when you explain the rolling returns, it shows that on a consistency how well this index scores when it comes to 3 year and 5 year period.
Absolutely. In fact, we looked at the market cap allocation as well, because a lot of investors and advisors are tracking market cap allocation between large, mid, and small very actively. And when we looked at market cap allocation as well, what we found out was this strategy has about 87% allocation on an average to large caps, whereas active large cap funds have similar 86. But where it becomes different is the balance 13% that this invests in mid caps are the largest mid caps, which are pseudo like large caps. But whereas a lot of these active large cap funds have allocation to not just mid caps, which are even smaller mid caps, but also some bit of small caps over a period of time. So this gives you, those companies that are actually those market leaders, consistent compounders in the large and large mid cap space. Now, Niranjan, I found one of the specs around this slide very, very helpful. So let's understand this in a little bit more detail. Sharp, I know, is a measure of risk adjusted return. The higher the Sharp, the better. So the Sharp is looking significantly higher than large cap funds. Standard deviation, which is volatility, is in line with large cap funds. So it's not extremely volatile. And Sortino is also higher. The higher Sortino is better. Can you explain Sharp and Sortino a little in a little simpler fashion for us to understand?
Yeah. So Sharp actually, shows how better the returns are compared to risk or volatility the strategy generates. Sharp is basically nothing but average return minus risk-free return divided by standard deviation. Uh, so a higher Sharp, as you rightly mentioned, is better, and 0.37 Sharp ratio for this strategy versus a large cap fund that is 0.25 is very good. It shows that the amount of standard deviation it takes actually it generates much better returns. So return per unit of risk or per return per unit of risk which it takes are much better in this strategy versus a large cap fund. And we have seen this also when we compare with Nifty 100, which is a plain vanilla market cap based index. Sortino actually is a much more deeper analysis of risk because a lot of people say okay, if markets are up maybe 20%, we are okay if the index generates 20% or 25% or even 18%. But we are not okay that if markets fall by 20%, this index falls by 22 or 23%. It should fall lesser because that is what an ideal ask is from any investor. Now, Sortino captures the average returns during or divided by downside deviation. So downside deviation is basically when markets are very volatile and falling, what is the standard deviation during this period? uh, Sortino checks how this fund has done well versus those downside deviation. So it's basically a stress test in terms of risk adjusted returns, and here actually it scores very good versus a large cap active large cap fund, which is quite surprising because when we compare a large cap fund versus a normal market cap based index, the Sortino ratio is very good because generally an active strategy does well in a falling market. But this strategy actually outperforms even that strategy, which is, icing on the cake. So 0.83 Sortino is, very few strategies can generate this. And again, here the hero is the combination of these two factors, which is alpha and low vol. Low vol is playing the magic again here to save your downside deviations.
I'm actually sold as I see this because it clearly tells me when markets do well, my returns are captured. And when markets do badly, my downside has a safety net, which is what India is all about, right? So if you come to think of it, India is a high alpha market. We're one of the highest growth economies in the world. We are creating alpha for the world. And if we are creating alpha for the world, you want to be in a product that is creating alpha or capturing that alpha. But at the same time, through historical data, we also know that India is a bit more volatile and you need something that puts down that safety net in case of a market correction, which this strategy has done very well. And Sortino actually puts that out very evidently. Now, a lot of advisors also use funds for SIPs, and clients use SIPs as a wealth booster or wealth creation tool. When we look at 5-year and 10-year SIP returns, 25% SIP return from a large capish product is phenomenal. A 10-year SIP from a large capish product touching about 19% is again super. I know when I speak to a lot of advisors, a lot of IFAs, the discussion is about 15 to 18% should be the return range for mid cap and small cap funds. Here we're looking at 19% SIP returns from a large cap product. So it clearly is done exceptionally well. In fact, we looked at multiple large cap funds. One of the best large cap funds in the industry, the SIP returns were at 16%, and it's outperformed that massively. So Niranjan, let's dive a little bit into the portfolio itself, because all of this, what we've seen now, is driven not just by the model, but the model has picked up stocks and companies and formulated a portfolio. And when we look at this portfolio, what does this portfolio tell you?
So, if we look at the portfolio, one very important, observation, which at least I can make is the diversification. Now, if you look at any market cap based index, the highest weight, even if it's a 30 stock Sensex, which is the most popular index, the highest stock weightage is more than 10% today.
Correct.
The top three or top five stock takes away almost 40-50% of the exposure in many cases. Here, most of the stock exposure is capped at 5% on an average, and you get a very, very well diversified 30 stock portfolio. So that the stock, which is even the 30th stock in terms of weight, it gives you a meaningful alpha, when it comes to overall performance. The second is the average market cap of this index is 1.93 lakh crore, which is, it's in many cases, it is higher than the average market cap of most large cap portfolio, which has 60, 70, stocks. So here you're getting, I would say, the best large cap stories, also the best larger mid cap stories, and in a much, much, a diversified way, and which performs better in terms of risk adjusted.
What I also clearly, comes out, and there is no maths or calculation behind this one, is a lot of these companies look like businesses that are very, very stable. A lot of these companies also tell me that they're not businesses that are volatile at all. And some of these businesses have created a lot of wealth for clients. And I'd be happy to just, without knowing the model or what Jensen's alpha is and what standard deviation is, I'd be happy to just hold a portfolio of companies like this on me. Let's jump to the last part, which is also delving a little more into downside and what happens when market cycles turn south. On your screen, what you will have is three periods of where markets have gone into a correction mode. The first period is this period of 15-16, where the Nifty 100 gave you a negative 20+% return. The strategy safeguarded returns by falling less than 15%. The second period was that sharp drawdown during COVID, where Nifty 100 corrected by almost 38%. This corrected by about 31%. And that last period of 2022, where Nifty 100 corrected by about 17%, this corrected by about 19%. This was the only instance where it corrected more during large market corrections. So Niranjan, these two are great. How do you explain the third one?
Right. So here, basically, it is also because of a few stocks which have fallen quite sharply during this period. However, if you see, recovery was very, very why recovered a period when it comes to covering that 19% fall. So that's broadly I can talk about this period in specific.
Done. I think we've covered a lot of ground. We've showcased that the strategy is really working across multiple time periods. I think this is a great time to go in for Q&A. If you have any, please do send out your questions on the chat window, and we would be happy to take questions from advisors and investors.
Warren, it'll be useful if we can also cover the rolling returns. Maybe you can throw some light on how it has performed on a rolling return basis.
I think Niranjan, there was a question around rolling returns as well from Girish. Please speak about 5-year rolling returns. So why don't you cover that?
Right. So we have covered rolling return not just for 3 and 5 years, right from 1 year till 10 years, since the inception of this index, since the time we have backtesting data for this index, which is April 2005, which roughly covers more than 20 years period. If you look at the 10-year rolling return, 100% of the time it has outperformed Nifty 100 TRI. What is important also and to see is the amount of outperformance. On the middle columns also talk about the bands of excess performance. And if you look at this band, which is more than 4%, 96% of the time it has outperformed, and that outperformance has been more than 4%. On an average, the excess return is 6.3%. Now, this is, phenomenal. You were rightly pointing out that a lot of people talk about mid caps outperforming the large caps by 2 to 3% over a longer period of time. Here's a strategy which is large cap oriented, 85% large cap, and outperforming a large cap. I mean, nothing can get better than this. Let's move to 7 years and 5 years. 7 years, again, 100% of outperformance, 74% of the time, more than 4%, average excess return of 5.9%. 5 years, 88% of the time. 3 years, which is largely, most people look at 3 and 5 years, it's 76%, and more than, 60% of the time outperforming more than 2%. Here again, average excess returns of 4.6%. While 1 year is a very short period, Varun, but even on a 1 year basis, 71% of the times outperformance is just phenomenal. An average excess return of, again, 4%. So across period, the average excess return is moving from 4% to 6%. I mean, nothing more to speak about the strategy, actually.
Absolutely. The other question, Niranjan, that's come in is on index construction. Now, two parts to that question. The first one is the fact that when or how often or when is the rebalancing done? The second one is market cap a factor to be looked at during the index construction?
Yeah. So the rebalance happens semi-annually, which is December and June. So the new portfolio comes in Jan and July. And this is broadly, similar for most factor-based indices that are there, that are launched by Nifty and NSE. So rebalance is semi-annual. I also wanted to point out the churn ratio of the strategy. The churn ratio is actually, quite low. Over the last 3 years, on an average, the churn ratio has been around 0.3. So which is quite low. In many cases, much, much lower than an active strategy also. Your market cap based index churn ratio is somewhere around 0.15 to 0.2 for a longer period of time. So, in line with that and not too high. Second question, Varun, sorry, I forgot.
Is market cap anything to do with index formulation?
Okay. So here, when it comes to multi-factor, what happens is the weights are aligned or assigned based on the scores of alpha and low vol. Let me just give you a simple example. Out of 150, there is one stock whose score on alpha.
I think Niranjan's run into a bit of a problem there, but let me answer that till the time Niranjan joins back. So market cap is not a factor that...
market cap doesn't come into picture. The final weights are assigned based on the total scores, the combined scores of alpha and low vol.
Niranjan, I think there's a lag on your side. If you can switch off the video, it'll just help free up some bandwidth.
Sure, maybe.
Okay.
So did you miss me somewhere? Should I?
No, we captured that market cap doesn't come into play in index formulation. Moving forward, the next one is a question basis the skeptics out there. When does the strategy underperform? During what time period will it underperform? And if it underperforms, how fast will it recover?
So as I mentioned, Varun, most, and it is not true only for this index, but most factorial index, since the rebalancing happens on a semi-annual basis, there could be period in between these two periods, which is 6 months, where the market tide turns or market cycle turns very swiftly, and sectors that were doing well maybe 6 months back are not doing well, and there are some very different sectors that are leading the rally.
Understood. The next one is are midcaps part of the universe? Yes, the top 50 midcaps are part of the universe. Uh, the next one is what what historically has been the combination of Jensen's alpha and low volatility proven. In fact, we showed that in terms of performance. In terms of performance, what it's proven is clearly that it gives you superior returns over multiple time periods, over 10, 5, 3, 2, and 1 year. It's given you superior returns. So over a lot of these time periods, the fund has outperformed. Niranjan, if you can take the next one. The next one is around tracking error. And does having the 50 mid caps cause a lot of tracking error? What has been the historical tracking error that you've analyzed, and will mid caps cause more tracking error?
Right. I hope my voice is audible,
Yes,
Varun.
yes, it is.
Okay. So tracking error, it's a very important and good question. When we talk about this index in particular, it is investing in the top 150 stocks. Now, the largest stock we know runs in multiple lakh crores in terms of market cap. The 50th stock, 150th stock, if you look at, the average market cap runs somewhere around 70 to 80,000 crore. In fact, more than that. Now, this 150 stock universe is actually one of the most liquid universe out of the 5,000 stocks that we have in India listed today. Free float for most of these stocks are very, very high because these are represented by finance, IT sectors where promoter holdings are quite small. And hence, when we look at liquidity profile of this 150 stocks, I think so these are the most liquid names, and hence the replication of this index is not a problem. Tracking error. So while I can't assign a number, but for this strategy, but broadly, if you look at 150, any strategy based on 150 stock, a tracking error of somewhere between 0.15 to 0.25 is where the tolerance band is. Also, what is more important is tracking difference, because while tracking error talks about how well the replication is happening, tracking difference over a 1 year, 2 year, and 3 year period also defines that whether the index is actually, or whether the fund is actually delivering closer to index return. Because at times it may happen that tracking error is just 0.15, 0.25, but tracking difference is much higher, maybe 1% or higher than that. Again, here, since these are top 150 stocks, replication becomes very easy. Any trades becomes very easy to go through. And over here, even tracking difference, X expense, I don't expect it to be more than 0.35 to 0.45 on an anecdotal basis when we look at strategies which are running on these, kind of indices or in this universe.
Sure. The next two questions probably I'll take. The first one is, what is the expense ratio? The expense ratio in the regular plan would be 1%. The next one is, how often is the rebalancing done? The rebalancing is done on every January and every July. The next one is, I didn't understand the question too closely, Niranjan, but if we have an answer on this one, does this strategy have a buffer of stock rebalance, and does it retain stocks to rebalance from time to time? How I think, if I'm trying to understand, is during rebalancing, if the stock is the same, do we sell it and re-enter that stock? If that is the question that I'm understanding from this one.
Yes, there is a buffer. So most NSE Nifty indices do have a buffer, because the 150 stocks are just not based on their ranks of market cap, because the market cap can change. And the underlying index or the underlying universe is Nifty 100 and Midcap 50. Now, when you look at these parent indices itself have roughly around, if I'm not wrong, 20% buffer. So even if the 100th stock moves to maybe 15th or 20 in terms of ranking, it is still part of the index. So hence, this buffer takes care of unwanted churn. And it shows up in the number when I said the churn ratio is somewhere closer to 0.35 for last 3 years. It shows that there is no forced churn in the portfolio. And most NSE indices or Nifty indices have these buffers in place, whether it is at the parent index level plus the strategy level itself.
Niranjan, one final question. Historically, are there any sectors that have shown high Jensen's alpha and any sectors that have shown high or low volatility that are consistent over periods of time?
Right. So again, a good question. But as far as alpha is concerned, alpha keeps on changing because it is based on price return, and price return on a relative basis can come in from any sector. But when it comes to low vol, specifically, we have seen sectors like healthcare, sectors like maybe IT to some extent, and FMCG, specifically FMCG and healthcare, historically have had very low standard deviation in their stock prices. So hence you will see a slight tilt towards these sectors in the index. But as far as alpha is concerned, it's quite dynamic in nature. At least in my observation, I haven't seen any one sector having consistent alpha because it's purely price based. And when you look at year on year sectoral returns, in last 10 years, there's no one sector which is in the top five always.
Yeah. I think we've answered a bunch of questions. I think we've also showcased that the product has a lot of merit for investors who are looking at a large cap solution. I request all of you to reach out to your Edelweiss representative for the presentation decks, etc. The NFO starts today and is on till the 10th of May. So please evaluate. And if there are any more questions, the team on the ground are equipped and close to you to take those questions up. I think Niranjan, we've answered most of them, but happy to take more if they come our way through emails or phone calls. So with that, thank you all and have a great evening ahead. And thank you to you, Niranjan.
Thank you, Varun.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.